Hi, and welcome everybody. I'm Dr. Sam Roscoe. Today we're going to be talking about inventory management, and also we're going to be talking about the role of inflation as well as the high interest rates that we've seen over the past several months and over the past year, and how that affects the usage or misusage of inventory in global supply chains. So we'll just open up my screen here and we'll begin to talk about this concept of inventory. And it's an absolutely critical concept within global supply chain management as well as within operations management. And we'll begin to pick this apart a little bit by just going through sort of two simple slides. That one of the slides will talk a little bit about the high inflation rates that we've been seeing since the pandemic, and then we'll begin to talk about how higher interest rates are beginning to affect or are affecting the accumulation of inventory in global supply chains. So what you can see here is a graph that compares the rate of inflation in Canada versus the rate of inflation in the United States. You can see that the two graphs pretty much are trending very, very evenly with each other. And what's interesting about that is that they have sort of a lot of similarities in place. So we're going to sort of treat North America then as a market, and we're going to look at what's happened over that period of time. So as you can see, from 2018 to 2020, inflation rates were relatively stable, between 3% and even down to around zero or even negative at some points within the United States. And what was interesting is when the pandemic hit in early 2020, and we all went into lockdowns, whether you were in Europe or in North America, what we began to see was a very, very big dynamic change in demand patterns. And what happened is a lot of people stopped driving cars because they were working from home. So the demand for automotive absolutely plummeted. We also had a big drop in demand for services, any type of service, restaurants, hotels, any sort of service where people would have to go to and experience that service. That demand totally fell. And as a result, you can see that the first lockdown in 2020 very, very closely trends with a drop in inflationary pressures on prices. And basically what that meant is that we began to sort of adapt and thinking about what other things could we do in order to get around this. And what people began to do is buy other types of commodities. So they bought electronics, they bought mobile phones, they bought webcams, and the demand for things such as semiconductors that go into both automotive, into aerospace, and also into electronics, that the demand for semiconductors moved from one industry to another industry, which is from automotive to electronics, for instance. So we saw this sort of shifting demand pattern. And what was interesting there is as you see this big sort of tank in prices where factories were shutting down, people were buying less, the governments began to respond to that by pumping money into markets. So using monetary policy to begin to provide consumers money in order to stimulate the economy. And by providing that money, especially in the United States, as well as in the UK and Europe, governments were basically giving more liquidity to people so they could purchase more items. And you can see here, as that sort of monetary policy began to take hold, we then had a different trend, which was another big spike in demand for anything that people could buy online. And a lot of that was either types of consumer goods. Again, electronics were a big winner here. Also telecommunications equipment. So you can see as we're moving into 2021, the inflationary pressures are getting bigger and they're getting bigger. And then as we go into mid 2021 into 2022, another interesting sort of phenomenon was going at the same time. And this happened in the transportation industry. And what happened there was shipping companies were beginning to take capacity offline in response to the initial lockdowns of the pandemic. And companies such as Maersk, CMA, Hapag-Lloyd, they began to take container vessels off of line and they began to dock those vessels. And that took capacity off of the market. And what ended up happening is we had a huge jump in prices for containers. We also had, we saw container prices from, let's say, Shanghai into Long Beach go from $1,200 to $1,500 a container, up to $8,000, almost $10,000 a container. So 5 to 10-fold increase in terms of container prices. We also had in the airline industry where aircraft were being, commercial aircraft were being parked, and then what the airlines were doing, they're stripping out the passenger seats and turning those into cargo aircraft, and that also had a big price increase as well. So all of those goods that were being made in places like China, Indonesia, Bangladesh, Vietnam, were being shipped to North America, especially on the West Coast. They had the big price pressures in terms of transportation. And that began to inflate pressures even further, as well as, there was a large demand, so companies were able to raise their prices. So we saw these these big inflationary prices coming all the way into 2022. And now, as we're in 2023, and I'll talk a little bit about inflation rates and interest rates in a little bit, governments have begun to step into markets and to put the brakes on this rising inflation. Now, the reason why this is interesting is, as procurement manager, as a supply chain manager, there's a number of issues here. So the first thing is, when I began to see a big demand spike in 2021 with monetary policy, like I've explained, as people begin to spend more, they're saving money because they're not going out as much, they have more money available. That then began to lead into a big surge of products coming from Southeast Asia into North America. And what companies were doing there is they were overproducing because of this big unpredictable spike in demand. Companies were purchasing more and buying additional products than they would have needed in anticipation of being able to sell it when they got it to North America. Now, the key issue that we have here, though, is shipping something from Southeast Asia to the West Coast of North America typically takes between 20 to 25 days on a container ship. That's just to actually ship the product. Now, we also have to think about placing these orders. Now, when a company places an increased order, that puts capacity onto the suppliers. The suppliers then have to find capacity on the production line, which is very difficult to do, especially during COVID when we had plant shutdowns. We had social distancing where workers had to be separate. There was less workers in the warehouses and the factories making and moving all of these things. And you had all of these factors going on at the same time, in addition to this big spike in demand. Now, because it takes about let's say 20 to 25 days to move a product, I have to place my order onto my suppliers overseas. I place that order to, let's say, a supplier in Vietnam. They then have to find capacity. They then have to make the products, and then they have to put it into a box and then onto a pallet and then ship it over to us. That can take anywhere between 3 to 4 months. So what we have then is we have a lag between supply and demand. And that lag time, because we have so much coming from Southeast Asia and China into the West Coast of North America, that lag time of between 4 to 6 months means that we have to have inventory at various stages of our supply chain. That inventory can take the form of boxes and containers. Those containers are sitting on container ships. Those container ships are essentially floating warehouses that are floating on the ocean, moving from Southeast Asia into Long Beach or into Port of Vancouver. Now, what's interesting about that, though, is we have finished goods inventory, but we also have work in progress inventory. And as demand is rising, we have more work in progress inventory from our suppliers that are making our increased demand. And then they also put pressure on their suppliers to bring in more components, to bring in more raw materials. And this big spike in demand that we saw coming from North America rippled all the way through the supply chain. And we had not only the 4 to 6 month time lag, but we also have additional time lags to bring in those raw materials and that components. And that can be anywhere from 6 months to 9 months to a year. So what ends up happening is we have a big spike in demand, and that ripples all the way through the supply chain over a 12-month period of time. And at all of those points in the supply chain, we have inventory that's being held. And one of the things that I stress to my students is that when you have long and complex global supply chains, that leads to more pipeline inventory. That can be raw materials inventory, that can be work in progress inventory, that can be finished goods inventory. And that inventory sits at various points throughout the supply chain. Now, what we're trying to understand today is when we have these big spikes in demand, that leads to more supply, more inventory. And as we understand the purpose of inventory, it is essentially to act in a various variety of ways. If my demand can be perfectly synced with my supply, so I can make something immediately to fulfill demand, I wouldn't need inventory. Where companies get into issues with their inventory is that they have a big demand spike, but their supply, as I mentioned, is anywhere from 4 to 6 to 9 to 12 months, depending on which part of the supply chain that you're looking at. So you have this time lag. Now, what we see here is as demand is spiking and as we have these inflationary price pressures, companies are bringing in more stock. We have all of the issues with offloading containers at the Port of Long Beach, at the Port of Tacoma, as well as the Port of Vancouver on the West Coast. And that is because, again, we don't have enough workers on the docks. We have issues with chassis. There's not enough chassis available. There's not enough people inland to unload the containers. And we have these port constraints that are happening as well. And then we end up with all of these vessels. I think it was around late 2021 into 2022 with all of these vessels that are parked outside of the ports, leading to anywhere between 70 and 80 container ships parked outside of the Port of Long Beach. So why that's particularly interesting is we have so much supplies being then pushed onto the market, but over time, as inflation is increasing and people are finding prices are getting more expensive, they began to sort of pull back and they began to spend less money. And at the same time, we have interest rates that are increasing, and that's bringing down our inflationary pressures. And people are beginning to think about, well, it's costing me more money to buy things. I'm going back to work now. I need to stop spending so much money online, and I'm going to basically curtail my demand. Now, demand stops, but you have to remember we still have 6 to 12 months of inventory in our pipeline trying to fulfill that demand that was already created earlier. So these long and complex global supply chains are essentially unresponsive. And that leads to these issues where we have companies now, especially in North America, that were holding all types of excess inventory because of this demand spike that they're just beginning to sell off and just beginning to get rid of from back in 2022 and early 2023. So that creates, again, that leads to retailers then having to discount that inventory at a reduced price. They're having to do sales, they're having to move it at any means possible in order to bring in new stock and also to get it off of their books. So it doesn't look like a liability on their balance sheet. The other issue that we have, of course, is when I know as a purchasing manager, I know that the inflation is going up. That also tells me that I need to buy now because the products that I'm buying from my suppliers are getting more expensive. So what I do is I buy more in advance in order to get ahead of those inflationary pressures. And I also, not only do I buy more in advance, I also purchase additional stock in order to meet this big spike in demand, which then creates more inventory. So if we look at this next slide, you can see how the interest rates are very closely correlated with, first of all, the big spike in demand that we saw during the pandemic. You can see from 2020 all the way until 2022, interest rates were kept incredibly low, 0.25% in the United States and Canada. And then as we emerge from the pandemic, you can see that the interest rates are coming up and up and up. And why that is particularly interesting in terms of an inventory point of view or from a purchaser's point of view is as I know my interest rates are beginning to increase, that also means that I will begin to purchase additional stock earlier because I know my prices are going to get higher. I know I'm going to be paying more for my supplies. My suppliers are going to be demanding more because their interest rates are going up and they have to get loans from the bank because they have to pay the bank more money. They pass on those cost increases to me as the buyer. The other thing that interesting part about interest rates is the effect that it has on working capital. So one of the big issues with holding a lot of inventory in your supply chain is that inventory basically is tying up the working capital that I have as a business. And that working capital basically is locked into my inventory, and I don't get that liquidity back into my business until I sell that product to a final customer. So again, the more inventory that I'm purchasing and bringing it in and I'm holding, that is tying up that working capital that I could be using somewhere else. That money could be used to invest in things, I don't know, to start up a new brand or to do a share buyback or whatever I want to do with that money. I have this opportunity cost of having the money tied up in that working capital. Okay. Now the problem that happened that creates is as interest rates are going up and I have more working capital tied up in my inventory, that basically means that I then have to go to the bank to get additional loans. And as I go to the bank to get additional loans, I then have to pay a higher interest rate on my loans. So instead of having let's say 0.5% loan from the bank, now where I am in the end of 2023, it's costing me anywhere between, let's say, 5.5, 6.5% in order to get financing or loans from the bank. And that puts increasing price pressures onto me as a purchaser or onto me as a company. And these are sort of the different dynamics that are creating between interest rates and inflation, and how that leads to companies holding excess inventory and beginning to tie up more money into their into the excess inventory that they're holding. So we're just going to leave it there. Thank you, everybody. Hopefully that was useful. And we will have another session shortly on the role of inventory management and why people purchase inventory in the way that they do. Thank you.